Good afternoon, everyone, and welcome back. This is Daily Trading Analysis with a quick market update for today, August 1st. We are starting the month of August with a lot of red. Huge sell-off due to some concerning economic data that came out today and is reinforcing the fact that the economy, US economy, is slowing down, and there are starting to appear some fears of recession, some concerns about the growth, and obviously that's something, the most important thing for the markets, growth and strength in the economy. Initial jobless claims came higher than expected. That's a check in the right direction for the Fed. Non-farm productivity came super high. Labor cost came quite lower. All these are checks in the right direction. Continuing jobless claims higher than expected. And also, in terms of manufacturing, we have the PMI final for July below 50, coming from 51. Remember that below 50, it's contraction of the strength on the manufacturing, contraction territory. Manufacturing ISM PMI came 46 from 48. We were expecting 48, so another check in the right direction for the fight against inflation. And employment, huge move below 50, 43, coming for 49. New orders came way lower than expected, while prices are higher. So all these data, everything that we got today, it's pointing towards downward pressure on the economy. We are seeing a slowdown in a lot of sectors. And as you can see, we are pricing in heavily 80% probability of an interest rate cut in September, 73% of another rate cut in November, and 70% of a third cut in December. 3 rate cuts for this year. And this is showing you how much of a necessity analysts think the economy is needing. They are basically, they are screaming, the markets need, the economy needs support. Fed, you need to cut rates. And this is something that usually happens when we are about to cut the first interest rate. It's because what the Fed is doing is working. Fed wants to slow down the economy, housing sector, labor market, prices, growth, everything. And at some point, this is super difficult because you have to have the balance in order not to enter a recession while slowing down your own economy. And what the market is saying today, it's we are very worried. We are worried. We have a lot of concerns regarding the strength of the economy due to the latest data on manufacturing. This is the 1 hour time frame chart. Yesterday, I was telling you, this is looking good. We had the manipulation move to the downside, a Wyckoff manipulation in the lows down here. And we broke out to the level that I was watching, the 50s, 60s of 19,500s. We opened last night, overnight was holding, and then the open came out and we starting to see, we tried to go higher and we got the first data here and the second data up here, number 1 and number 2. And that was the high of day. We have a lot of pressure up here and we've been seeing this is happening day after day. This 45 EMA is just like butter. When you have this trend, there's no way you are going to play some longs unless something turns out, closes out of the 45. And this is the 1 minute. In the 5 minute, we have an even stronger downtrend. Today, it's more of the same. We are basically being destroyed. I think today it's a lot of long liquidation from this overnight move. And this is the NQ. And we basically, it was yesterday's low. We took that and we continue selling off. So what's the next level? The next level, you have it right here. Another 10%. I don't know about you guys, but these 10%, these 18,885, it's no longer strong in my eyes. I was watching these blue boxes. These blue boxes are order blocks in the 30-minute. We have this order block in the 30-minute, and in the 1 hour, we have another block here. So in between these two blocks, I marked my zone of basically some pullback. I tried to watch the price action at these levels. We got a bounce at the open, and I was saying, okay, let's see how it behaves after the data. And we just melted through everything, 2.44 on the Nasdaq, with 5% on Tesla, consumer discretionary, with 1.40 on Amazon, consumer discretionary, with Nvidia 6% down, and Meta, which basically had pretty decent earnings. But right now, I think earnings until, let me just show you some news. Yesterday, we got Meta, ARM, and Qualcomm. We got Meta super strong earnings, and we have ARM also. Guidance pretty decent. So there was bullish news for earnings. But today, Thursday, I think the only thing that can change this sentiment is Amazon, Apple, and Intel. And let me tell you, if these stocks, if these guys do not report pretty big earnings to the upside, we are going to melt down more than 3% again. Because look at this. This is hell for longs. This is heaven for shorts. I got my breakdown. I have my technical analysis. Everything was looking pretty good. But as always, we have this zone that we basically melt off due to some more catalysts on the data. So at the end of the day, price action is confirmation of some fundamental catalysts that are concerning. And in this case, we have strong correlations with a lot of things. Let me just show you what is happening in the volume for the Nasdaq. This is the ES, the S&P, strong volume to the downside and strong decliners on the day. Look at this push. This is pretty heavy. And on the tick chart, we have a lot of move to the downside. We have a lot of pressure down here. A lot of candles on the tick chart are below zero. And in terms of the Nasdaq, we have, again, some huge move volume going out of the market, and at the same time, huge sell-off to the downside. These are the two moves of today. These are melting. Apart from that, we have a strong dollar. 0.34% today, holding with a higher low. It's pretty good, but this is not the biggest concern. The biggest concern is that gold, the safe haven, it's seeing some inflows also. And the 10-year yield, it's been demolished. Below 4% since it was, let me just show you here, since February this year, we have not been at these levels. We've been going lower and lower and lower, and this is the long-term yield. This is the US 10-year. This is the one that shows you how strong is your economy. And the two-year yield was also being destroyed because this is the short-term controlled by the Fed. So when the Fed starts signaling that they are going to cut rates, obviously this is going to melt. But what is happening with these two yields and the inverted yield curve is something worth noting. I told you that as long as we continue on inverting, we are going to see volatility increasing. And at this point, when an inversion happens, maybe if we start cutting rates, there's something that is broken in the economy. And that's what everyone's fears about. The Nasdaq is being destroyed because tech earnings are not strong enough, because the war, the uncertainty between Israel and Iran, a lot of things on the manufacturing, housing sectors. I mean, there's a huge momentum change in the sentiment to the downside, and we can clearly see that in the daily candles. Yesterday, I told you this is pretty decent, bullish engulfing candle, but now tides have changed, and we have to adapt. Really, we have to be flexible and don't be overconfident, because this kind of strong sell after yesterday's push to the upside, this kind of volatility is insane, insane. And I think the last thing that I would like to tell you is I always prepare some kind of statements from the FOMC real quick. Yesterday, something changed. The Fed repeat that it's not expecting that it will be appropriate to lower rates because it needs more confidence about the sustainable move towards 2%. But there was changes in the statement. They changed. There has been some further progress instead of the modest further progress. Inflation remains somewhat elevated, and it is a tempting risk in both sides of the dual mandate. The dual mandate is inflation, price control, and then labor market progress. And they are not worried now about inflation. They are changing their concerns to the second mandate. Economy continues to expand at a solid pace. Jobs gain have moderated, and employment rate has moved up but remains low. They expect unemployment to go up. We have made considerable progress in both goals in the past 2 years, so it's better balance. Spending has slowed. Labor market has returned to where it was of the eve of the pandemic. It's strong but not overheated. And the downside risk is with the employment mandate. This is what everything's about right now. Jerome Powell doesn't want to see excess cooling in the labor market. And this is concerning because in terms of interest rate cuts, they need greater confidence. Q2 inflation readings have added confidence, but reducing too late could weaken the economy. So this is your first signal. They are worried about the labor market, and at the same time, they are worried about the second part of their mandate, the labor market. So something is changing in the approach, in the way they are stating things. Something is changing. They are not sure about September rate cuts, but as you saw in the Fed Watch, there's a lot of price being priced in, a lot of move priced in already in September, November, and December cuts. Rate cut in September would be on the table. It's on the table. They can be 0 cuts or several. Markets are for sure betting on 3 rate cuts, and there will be time to adjust rates to support the process. So this is the key to really understand what is happening today. The key is to understand that the economy is weakened. Markets are freaking out. Until the Fed shows support, we are going to see this kind of volatility. And there's a lot of correlation with other parts. Yields going down, peaks going higher, 18%, small caps getting destroyed. The RSP is being destroyed. We are coming back again into the range, and momentum is slowing down. These businesses are the first that in a recession, in a possible recession, they are going to be the most impacted. So a lot of things that we have to digest. Maybe this is so overextended. Who knows? But what is true is that what I claim to be one of the good setups to the long side to really see 20,000, that's no more. That's no more. I'm not bullish anymore. I will be super cautious on the 10% third type. We have the first tap, the second tap on manipulation, and a third tap I think is going to be quite bad. So be really careful, guys. This is a big change in the markets. A big market state change. It's something that you have to be aware, and you have to manage your risk, because tomorrow, Friday, we are starting August. Maybe August is going to be a continuous sell-off, and September we will see if Fed cut rates or not. Until then, be super cautious. You can be destroyed in one day like this if you don't manage your risk. Today, from high to low, it's another 700 points. The volatility is huge, and we are seeing big lots of volume selling thousands of contracts. So I think I've explained you enough catalysts and enough correlations for you to understand what kind of market we are in. I don't like it, but I have to respect the price action. And if I'm long and if I want to go for longs, I have to be extremely careful. That's my recommendation for you, I think, for the entire August. And that's all from my side. As always, thank you for your time. If you found this video useful, please give it a like, subscribe to the channel, because I upload videos like this one every single day for market forecasts, market updates, and market recaps. I appreciate your time as always. I hope you had a decent day. I hope you are managing your risk. And if you were short, congratulations. These kind of moves are pretty damn good. But be careful, because you have to really follow the sentiment to be on top of those positions, because at the end of the day, with a snap like this, you can be squeezed to the ceiling, to the heaven, and to, I mean, be really careful, both sides. This market is super volatile, and more into August, that would be quite a lot of risk. So discipline, patience, risk management, those are your key for your success. Stay safe, everyone, and see you tomorrow.